Most people believe investing is something you do once you're already wealthy. They think it takes thousands of dollars, complicated strategies, or maybe even a finance degree to start. But in reality, honestly, the hardest part of investing is just getting started, and you don't need a lot of money to begin. Just $100 can open the door to long-term financial growth. In this video, I'll walk you through exactly how to start investing with just $100, even if you've never bought a single stock in your life. We'll cover what to invest in, how to do it, and how to turn that $100 into the foundation for building real wealth over time. Let's start with the basics. Why invest at all? Think about this. If you leave $100 in a savings account right now, you might earn less than $1 in interest after a year. That's because most banks pay interest rates that don't even beat inflation. Your money is technically losing value while it just sits there. But if you invest that $100 in the stock market, especially in strong companies or diversified ETFs, you give it a chance to grow. Historically, the U.S. stock market has returned about 7 to 10% per year on average after inflation. That means your money isn't just sitting, it's working for you. Now let's talk about where to actually begin. Step 1. Pick the right platform. To start investing, you need an investment account. Think of this as the gateway between your money and the stock market. These platforms are also called brokerages, and they're where you'll actually buy and sell your investments. If you're brand new, look for 3 key things. First, low or zero fees. You definitely don't want trading fees eating into your small investment. Second, fractional shares. This lets you invest in expensive stocks like Amazon or Apple with just a few dollars. And third, user-friendly design, because honestly, if it's too complex, you probably won't stick with it. Top beginner platforms include Fidelity. It's got excellent customer support, no fees, and you can even buy fractions of a share. Then there's Robinhood's super simple design and no trading fees. It's really great for beginners, but, just be cautious of impulsive trading. Charles Schwab is a more traditional brokerage with excellent tools and fractional shares. And M1 Finance is best for set-it-and-forget-it investors who want automation. Whichever one you choose, just make sure you understand how it works and that it gives you access to what you want to invest in. Step 2. Set a goal for your $100. Before you invest, ask yourself, what is this $100 for? Is it for building long-term wealth? Is it for learning how to invest with a small amount? Or maybe it's part of your plan for retirement. Even with a small amount, your goal really matters because it helps guide your investment decisions. If this is money you need in 6 months, the stock market might not be the place for it. But if you're looking 5 or 10 years ahead, then it absolutely is. Step 3 is all about learning the basics of what you can actually buy. So, there are 3 common ways to invest your money in the stock market. First up, stocks. These are shares of individual companies. When you buy one, you actually own part of that business. Next, we have ETFs or exchange-traded funds. These are bundles of stocks that give you instant diversification, which is pretty cool. And then there are index funds, which are kind of similar to ETFs, but you usually buy them through mutual fund platforms. They track a specific index like the S&P 500. With $100, honestly, the safest and smartest approach is usually ETFs or fractional shares of stable companies. This way, you don't put all your eggs in one basket. Let's talk about what those baskets might be. Some top ETFs for beginners include VUO, which is the Vanguard S&P 500 ETF. It invests in the top 500 U.S. companies, is diversified, low-cost, and has a strong track record. Then there's VTI, the Vanguard Total Stock Market ETF, which covers large, medium, and small companies across the entire U.S. economy. And DGRO, the iShares Dividend Growth ETF, focuses on companies that pay and increase their dividends over time. These ETFs are great for long-term investors who want simple, set-it-and-forget-it growth. Some top stable stocks to consider are Apple, ticker symbol AAPL. They're a leader in tech and innovation and honestly one of the most valuable companies on earth. Then there's Microsoft, or MSFT, which dominates business software, cloud computing, and more. Coca-Cola, ticker KO, is known for its stability, global reach, and those reliable dividends. Procter & Gamble, or PG, makes everyday essentials and has been historically recession-proof. And Johnson & Johnson, ticker J&J, is a healthcare powerhouse with a really strong track record. With fractional shares, you don't need to buy a full $180 share of Microsoft. You can invest $5, $10, or $20 and still get a portion of the company, which is pretty awesome. Step 4, let's look at an example $100 portfolio. Here's a simple way to split your $100 investment. Put $40 in VTI for broad market exposure, $30 in DGRO for dividend growth, and $30 in Apple for exposure to a leading company with long-term growth. This setup gives you instant diversification. You own the market, collect dividends, and hold part of a tech leader. It's balanced, smart, and honestly pretty low risk. Step 5 is all about building the habit of investing. Now that your $100 is invested, the most important thing you can do is keep going. Wealth doesn't come from just one-time decisions, it comes from consistency. Try to add $25 or $50 per month if you can. Automate it. Most platforms let you set up recurring deposits and investments. This builds a habit and uses dollar-cost averaging, which basically means you're spreading out your purchases over time and minimizing risk from market ups and downs. Step 6, and this one's huge, keep your emotions in check. As your money grows, or sometimes temporarily shrinks, it's easy to get emotional. You might feel tempted to sell when things drop or chase after trending stocks. Don't. Emotions are really the enemy of long-term investing. If you invest in strong companies and ETFs, your only job is to hold. Remember, time in the market beats timing the market. Step 7. Learn while you grow. Once your money is working for you, make it your mission to learn. Watch investing videos, read books, and follow reliable voices in the finance space. The more you learn, the more confident you'll become. If you're looking for some beginner reads, I'd recommend The Simple Path to Wealth by J.L. Collins, The Little Book of Common Sense Investing by John C. Bogle, and One Up on Wall Street by Peter Lynch. These books were written for everyday people, not just finance majors. Step 8. Mistakes to avoid. Let's wrap up with a few rookie mistakes to steer clear of. First, falling for hype. Just because a stock is trending doesn't mean it's a smart buy. Next, over-diversifying with tiny amounts. If you only have $100, don't spread it across 20 investments. Also, not investing again. Make it a habit, not just a one-time experiment. And finally, investing money you need soon. The market is a long game, so don't invest your rent money. Final thoughts. Starting with $100 might not make you a millionaire tomorrow, but it starts a process, one that builds financial literacy, confidence, and most importantly, long-term wealth. You're not just buying stocks. You're building a mindset, a new habit, a better future. The best investors didn't start big, they started early, they stayed consistent. And they kept learning. If you're watching this right now, that means you're already ahead of most people. You're taking control of your future, so now the next step is yours. Pick your platform, choose your investments, and take that first $100 and put it to work. If you got value from this video, consider liking it, leaving a comment below and subscribing for more simple investing tips. I'll see you in the next one.